Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Matt Forrester, CIO of Lockwood at BNY Mellon, to discuss transitioning from rebound to recovery and how policy could impact the market with the administration transition. Matt, it's great to see you as always. Welcome back to Trade Talks.
Hi, thanks, Jill. Good to be here.
You got it. And while market participants are focusing on rebound to recovery trades, we still have a number of factors to be aware of out there.
Oh, we sure do.
And speaking of the administration transition, markets don't respond as much to who or what political party occupies the White House, but rather the policy that comes out of it. So in the shorter term, what do you think the market's dependent on?
Well, right now, I think we're very much dependent on the stimulus talks, and we're up against a deadline of Friday to get those done. And that's become incredibly important as we see, just here in the New York, New Jersey metropolitan area, we see something like a third of small businesses have gone out of business in 2020. And yet, we see that there's 700,000 more business applications in 2020 nationwide than there are in 2019. So it speaks to this creative destruction of the economy and how it's a Schumpeterian. Joseph Schumpeter was an economist that talked about how the ashes of the pre-existing economy create the conditions for new business to form. And so we're starting to see some of that. But in the short term, markets and the underlying economy are still very much dependent on getting another stimulus deal done here in the short run. And that's a very important measure. And I think that's been the number one thing that markets are responding to. But we're bumping up against some of these longer term constraints we have on the economy. I think you're starting to see that. We're running federal debt to GDP ratios of something that we've never seen before. We're seeing, more money than we spent during World War II or World War I or the Civil War. So we're bumping up against those constraints. I think you're seeing that show itself across the political dynamic. And I think it's something you need to think about. If your outlook for 2021 is built on way more expansionary fiscal policy, that may actually end up being unrealistic compared to what happens. I think you're seeing that going on in the Congress now. We're seeing more fiscally responsible members balk a little bit at the price tag of some of these new stimulus measures that might be enacted.
Right. It seems as if this asset bubble just continues to get inflated. And while I understand why fiscal policy is needed, more aggressive fiscal policy is needed, I think the confusion that many market participants have is that it's not true growth. It's not real growth. It's not like businesses are growing their bottom line or anything. It's just this money that's getting injected into the system. And I think once the piper has to be paid, there's some area for concern there.
Yeah, and that just highlights the concern around the near-term stimulus. Some of these packages are due to expire here at the end of the year, so there just needs to be some extension of the programs in order to help those businesses that are struggling through this near-term period. But it also speaks to something we may have talked about before, just the difference between Wall Street and Main Street here, where market capitalization is not concentrated in the sectors that have been mostly affected by COVID. I mean, transportation, retail, other types of hospitality services. There's millions and millions of Americans that are employed there, but they don't have a lot of market capitalization, for the stock market purposes. So the stock market has been rallying on hopes of a vaccine, on optimism about what they see as increasing growth rates for 2021. Almost all of these bullish market strategists have, a very high degree of dependency on a vaccine being successful, on being accepted, being widely distributed, and being efficacious. I mean, it's got to actually work. And so, those are, I think, some of the challenges for 2021. Also, markets here have gotten to almost extreme positioning. Almost every valuation indicator that you can look at are in their upper couple percentiles that they've ever been at. And I think that's really the concern, is how much of the bullish market sentiment for 2021 has been pulled into 2020 as we look forward to the vaccines, particularly with an epic November. We've had remarkable progress, and it looks like December is kind of marking time a little bit so far. And the markets left a tough week last week, but I think that if we look out in the future, there are a handful of these strategists that may have forecasts that are not much above where we are today. And
Right.
and that's the concern, is that we may have pulled a lot of this optimism into the later half of this year.
And then, Matt, this is a bit of a philosophical question. And I wonder if this is why we have so much bullish sentiment, while all the strategists are kind of in the same lane here. You know, for those of us that work in finance, for those of us that work in technology, we've been very fortunate that we were able to pivot and work virtually.
Yeah.
Our lives, our economic situations have not changed. In fact, some of them have fared better, with the exception of not being able to travel and do the things that we normally like to do. We haven't been impacted, right? And that's, you know, when we talk about the disconnect of Wall Street and Main Street, many of us just don't see that. And that's concerning to me, by just how far the market got ahead. And of course, this is more of a philosophical question than anything, but we haven't been there. We're fortunate, and I'm grateful for that. But Main Street, you know, you go down to Main Street where I live in suburban New Jersey, and half the businesses are just gone.
Yeah, no, I mean, it's been an unbelievable year for small businesses and restaurants, and you have to feel for them, and you really kind of wonder what the policy dynamic is likely to be. I remember we're going to have Janet Yellen at Treasury. Janet is a labor economist, so she really understands some of these labor dynamics and how impactful this has been for, you know, large swaths of Americans that, you're right, have not been as fortunate for some of us in the financial industry that just can work from a computer wherever we are. It doesn't really matter. You know, some people actually have to go to work and be physically present, and that has been, you know, a real challenge for them to make it through the year. You know, and I also think, if you think about going into next year, you know, this is really something that's on a wartime footing. You know, the policy dynamic that we're likely to see is something where the Fed and the Treasury may be more closely aligned than they've ever been since the period coming out of World War II. As I mentioned, we've already spent more federal dollars than we have at practically any other time in the nation's history in terms of GDP. And so I think that makes you worry a little bit about the kind of policy measures that have become that could affect the markets. By that, I mean really tax hikes. The Biden tax plan, as it was announced, was the fifth largest tax increase in American history. So, and it hits real sources of stock market demand. So, you know, high income households, corporate stock buybacks, and capital gains taxes are a place where that will affect stock market demand. So I think if you're thinking about it for the long run, you have to think about the cost of some of these policies that are likely to be enacted in order to try to help Main Street, you know, recover from what we've gone through here in 2020.
We certainly do, Matt. Great to catch up with you as always. Thanks for joining us on
Thank
Trade
you.
Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.